In every decision that we face, whether in life or in finance, we have to consider the trade-off between taking risks and potential returns. Whether it concerns investing in the financial stock market, choosing your career, or where to go on holiday, the trade-off is everywhere. What's the key? Well, the key is understanding this relation and understanding the trade-off that might exist. My name is Dyaran Bansraj, and welcome to this episode of Finance Facts and Fiction, in which we discuss the risk and return relation, our third fundamental. Let's get started. In every decision that we make, whether it's in life or in finance, we have to consider whether it is worth the risk. I'm not sure whether you recall this scene from Breaking Bad, but Walter White has just turned from a chemistry teacher to becoming a drug producer, and they just sold their first batch. Now, in this scene, Walter tells Jesse that the return is too little for the risk that they've taken. So in this episode of Finance Facts and Fiction, I want to discuss whether it's true that if there's more risk in a decision, you should also expect a higher reward. Generally, this relation is true. When we think about jobs with more at risk, such as firemen or people in the military, they should be compensated through a higher salary or other forms of bonuses. But also when you think about participating in a lottery, the smaller the chance of winning, the higher the potential gain should be before you decide to participate. And we can also find this relation in extreme sports, that the higher the adrenaline rush from pursuing the sport, the higher the risk you might be willing to take. So we find that this risk-return relation is everywhere, not only in finance. And when we consider some business decisions or business cases, we can think about jobs. Managers, for example, from football clubs, require additional compensation because they risk early contract termination. But also in financial investments, shareholders often take a higher risk than bondholders, and therefore they require a higher return. When we compare startups and mature companies, we find that startups are often riskier because they can more easily go bankrupt, but they also offer a higher upside. And finally, when we consider insurance, insurance is often more expensive when there's more at risk. So now I want to dive a little bit deeper into what we mean by risk and return. So what is a return? Well, let's start off with this idea that we often need to pay a price today, which we call the investment, to get some value or earnings in the future. And we know from the time value of money how we can compare those amounts. Now, how much we earn on our initial investment, that's what we call the return. For example, you play a game in which you roll a single die. Now, to play the game, you have to pay $3.50 and you earn the number of eyes that you've thrown. So let's say that we roll a 4, that means that we earned 4, we have to pay $3.50, and our profit is the difference, which is 50 cents. Now the return in this case is 50 cents divided by $3.50, which is 14%. And what is risk? Well, the risk is the chance that the outcome is different than expected, and in reality we care more about potential losses than unexpected gains. But it is also how far away our outcome is from what we expected. Let's now consider a game with two different dice. On the left hand, we have a special die which ranges from 3 to 4. And the expected outcome, therefore, is the average of the eyes, which is 3.5. On the right hand, we have a regular die which ranges from 1 to 6. The expected outcome is also equal to 3.5. Now if we play the same game where we have to pay $3.50 to earn the number of eyes, then we see that in the left hand case, we could either lose 50 cents or gain 50 cents, which are not big wins or losses. On the right hand side, however, the losses could be going up to $2.50, but gains could also go up to $2.50. So the wins and losses are larger. And as a result, we say that the left die has a lower risk. Now let's put this in a finance example. Let's say that you can invest in two projects. You can invest $950 today to receive either $1,000 next year with 100% certainty, or in project 2, you have a 50% probability of earning $2,000 and a 50% probability of earning nothing. So in the first case, our return or gain is $50. And in the second case, it might either be a gain of 1,050, or we could also lose our initial investment of $950. So which project do you prefer and why? Well, you have to see that both have the same expected return, because 100% certainty for 1,000 is the same as a 50% probability on 2,000. But one has a guaranteed outcome and the other is uncertain. So we say that the second project is riskier. Generally, we don't like risk, so we prefer project 1, and this is what we call risk aversion. And this brings us to the relation that the higher the risk, the higher the required return is. And we also find that this relation is true in finance. Stocks have a higher cumulative return than treasury bills. So in this figure, I've plotted the cumulative returns of the S&P 500 and the cumulative returns of US treasury bills over time. And we find that indeed stocks or the S&P 500 provide a higher cumulative return. But they also provide higher risk. In these two graphs, I've plotted the annual returns for both the stock returns and the treasury bills. And the height of the bar indicates the historic gain or loss. And as you can see, the bars are much larger when it concerns the annual stock returns than when looking at the annual T-bill returns on the right-hand side. So we say that stocks have a higher risk. So think about your friend that always brags that they did better than the S&P 500. Well, there could be a lot of reasons that explain this finding, but one of the reasons could be that they have taken more risk than what you essentially see in the S&P 500. So you should ask them, which risks have you taken? And if they don't know the answer, then maybe they should reevaluate their investment decision. At least you know better now. Now I hear a lot of you thinking, I'm not risk averse, or who cares about risk? And it's true that risk aversion differs per person, per event, but also over time. For example, when you grow older, you have less time to recover from your losses, so you're often more risk averse than when you're younger. And when you're using your leftover money to gamble or buy cryptocurrencies, that may be different than when you have to decide how to allocate your entire pension savings. Now, some managers may try to gamble their way out of trouble because they have little to lose and a lot to gain. In that case, they may actually become risk seeking. And we may treat gains differently than how we treat losses. Now, many investors do not believe that they are risk averse. And I want to stress that being risk averse is not necessarily a bad thing. Think about when you're close to retirement. If you have invested your pension savings in the stock market, you do not want a financial crisis to evaporate your savings. Or you could decide to drive safely to avoid you losing your life. In these cases, risk aversion is actually good. Now, to stress this point further, I want to show you how inconsistency in our risk aversion may actually hurt our returns. So consider two games. In the first game, you gain $10. And in the second game, you have the 50% chance or 50-50 chance on $20. So one is a guaranteed outcome and the other is a coin flip. Now, in these cases, some of you might go for the guaranteed value and others might go for the coin flip because the returns are not that large and therefore the decision is not that important. But if I change these numbers to 1 million and a 50-50 chance at 2 million, then I assume most people will go for the 1 million with certainty. But here's the thing. Taking many small decisions may lead to this one large outcome. And in finance and in daily life, we do make many of these small decisions. And together they start to add up and may add up to that $1 million with certainty. And that is why we should try to be consistent, whether it concerns a small decision or a large decision when it comes to the risk-return relation. Now, I briefly want to go back to this figure where we show that the cumulative returns of stocks are higher than of treasury bills. Recent research has actually shown that this is only because of a few top-performing stocks. Actually, most stocks underperform compared to T-bills. And this may explain why poorly diversified active strategies may underperform compared to market averages. So diversification may be important, and this is a topic I want to explore further in the next video. So again, with each decision, and potential returns, consider whether it is worth the risk. But it's about finding a balance between the risk and return, and this may depend on your own personal preferences or goals. So what is the fact and fiction of the risk-return relation? Well, the fact is, we mostly do not like risk, and therefore when we take risk, we want to be compensated for it. The fiction is that we only care about absolute returns and we can ignore the risk that we're taking. Alright, if you enjoyed this video and learned something about the risk and return relation, please hit the like button and subscribe to this channel. Now that we've considered the three fundamentals in finance, which we started out with the no arbitrage theorem, we talked about the time value of money, and we discussed in this episode the risk-return relation, we're ready to tackle deeper questions in finance and also think a little bit more about investing in the stock market. So that's what we're going to do next when we talk about diversification benefits. See you then.